Right now, the world's fourth largest economy has a currency sitting at its weakest point in 40 years this month. A nuclear-armed government is reportedly drafting plans to dip into its own citizens' pension savings, and the world's second-largest economy just missed its own growth target for the first time since COVID. 3 of the 10 biggest economies on the planet breaking at the same time. By the end of this video, you'll know exactly which one is actually in the most danger. Spoiler, it's probably not the one you think. Let's start with Japan, because what happened here in the last few weeks is genuinely strange for a country this developed. On June 30th, 2026, the Japanese yen fell to its weakest level against the US dollar since 1986, a 40-year low. To put that in perspective, 100 yen, which used to buy you more than $1 back in the mid-1990s, now buys you about 62 cents. The exchange rate crossed 162 yen to the dollar, and some analysts think it could keep sliding toward 170. Normally, a currency falling this fast belongs to a small, unstable economy. Japan is neither. It's the world's fourth largest economy. It makes the cars, semiconductors, and precision electronics the entire world depends on. It's not supposed to be the country with a currency crisis. So why is this happening? The short answer is debt. Japan's national debt has ballooned to 240% of its GDP, the highest of any major economy on the planet. And that number is the key to almost everything else in this video. To understand why Japan is sitting on the highest debt pile in the developed world, rewind to the early 1990s. Japan spent the 1980s as the economic miracle of the world until 1991, when that bubble burst. Stock prices and property values collapsed, and Japan entered what economists call the lost decades, because the stagnation didn't really end for almost 20 years. To fight it, the government spent enormous amounts of borrowed money on stimulus, while the Bank of Japan held interest rates near zero, sometimes negative, for longer than almost any other central bank in the world, just to keep that debt affordable to service. Stack a second problem on top. Japan's population has been aging faster than almost any country on earth. Fewer workers paying in, more retirees drawing pensions. Decades of borrowed stimulus plus a shrinking taxpayer base is how you end up with debt equal to 2.5 times your entire economy. None of this looked like a crisis as long as rates stayed near zero, because the interest on that debt was basically free. But inflation came back worldwide after 2021. Central banks everywhere started raising rates, and Japan eventually had to follow. Raising rates means the interest on 240% of GDP worth of debt stops being nearly free. And that's exactly where the current crisis starts. In April and May of this year, Tokyo tried to fix the falling yen directly, spending its own reserves to buy yen and sell dollars, propping the currency up artificially. It spent tens of billions of dollars doing this. It didn't work. The yen kept falling anyway. Robin Brooks, a senior fellow at the Brookings institution, put it bluntly: intervention like this is doomed to fail, because it treats the symptom, the falling currency, and not the disease, the debt itself. You can't fix a 240% of GDP debt problem by spending billions defending an exchange rate. Here's the part that makes this a global story, not just a Japan story. For years, because Japanese rates were near zero, investors worldwide borrowed cheaply in yen and used it to invest in higher returning assets elsewhere. This is called the yen carry trade, and it became one of the largest, most embedded trades in global finance. The problem is that it depends on stability. If the yen suddenly moves, crashing further, or the Bank of Japan hiking rates to defend it, those trades can unwind fast. And because so much money is involved, the unwind doesn't stay contained to currency markets. Investors sell stocks and bonds too to cover their positions. It's like thousands of people borrowing in the same cheap currency at once. The moment that currency stops being cheap, they all need to sell what they bought elsewhere at the same time. Analysts have already flagged this exact scenario as a risk to global markets, not just Japanese ones. So is Japan uniquely broken, or is this part of something bigger happening across the world's largest economies right now? 3 quick comparisons. Russia's federal budget deficit hit roughly $83 billion by May of this year, more than double all of last year's. Nearly a quarter of its bond market is considered at risk of default, and its finance ministry has reportedly been drafting legislation to access around $40 billion in private pension savings. When a government starts eyeing private pensions to plug a budget hole, that's not a warning sign anymore. That's the emergency itself. China, the world's second-largest economy, just posted its weakest GDP growth in over 3 years, 4.3%, missing its own growth target for the first time since COVID. Real estate investment has fallen 18% in the first half of this year alone. High-tech exports are actually accelerating on AI-driven demand, while domestic spending stalls, one economy pulling in 2 directions at once. The United States doesn't have Japan's debt ratio or Russia's default risk, but economists describe it as a K-shaped economy, AI-driven markets booming, while ordinary households report real financial strain. The IMF's own July 2026 outlook frames the entire global economy this way. Growth is real, but split between those riding the AI wave and everyone else absorbing the cost of war, debt, and stalled disinflation. 4 of the world's largest economies, 4 different problems: debt, war spending, a property crash, an uneven recovery. But the same underlying story. The gap between who benefits and who's exposed is widening almost everywhere at once. Japan is just the most surprising name on that list. This is the story the IMF has been trying to tell all year, in more careful language than a headline can capture. The global economy isn't in one crisis, it's splitting in 2. Countries plugged into the AI boom are doing fine. Countries carrying heavy debt, war exposure, or an aging population are absorbing the pain. Japan should be on the winning side. It's rich, developed, advanced, but decades of debt left it exposed anyway. That's exactly why it's the example that matters. Being wealthy doesn't automatically protect you from this divide. One nuance worth knowing before we close: Japan's debt is mostly yen-denominated and held domestically, unlike a country borrowing in a currency it doesn't control. So this isn't the same kind of default risk that's hit other economies before. Japan's actual options are all difficult in their own way: raise rates faster and risk a messier carry trade unwind, keep intervening the way that's already failed twice, or pursue the slow, politically hard path of structural reform. None of that is quick, which is exactly why this has been building for 30 years instead of resolving itself. Watch the yen for a possible move toward 170 and watch the Bank of Japan's next rate decision. That's the moment most likely to trigger the next shock. None of this means Japan is disappearing as an economic power. But if a G7 economy can end up with this little room for error, it's worth asking which safe economy gets tested next. Subscribe if you want to be there when we find out.